who else joins. So welcome to the fourth webinar in our AgForce Winter Series on sustainability topics. I'm Annie Rutledge, Senior Policy Advisor for AgForce, and I'll be facilitating this webinar. Sustainability really lies at the heart of why our agricultural producers are so good at what they do, often under highly challenging circumstances. Our producers are at the forefront of continually adopting new practices, and adaptability has always been and will always be crucial to the success of our sector. These webinars aim to equip you with knowledge to keep making informed choices. Over the coming weeks, we'll hear from subject matter experts across a range of topics relevant to sustainable agriculture. But before we dive in further, know that the information shared in these webinars is general in nature and is not a substitute for specialist professional advice tailored to your specific circumstances. Each farming business, region and context is unique, and there is no one-size-fits-all solution. A quick outline of the webinar tonight will allow our speakers to present and hold all questions until the end. Alternatively, feel free to put them into the chat and then I'll read them out during the question time. I'll now hand over to Mark Collins to briefly introduce AgForce and the Sustainability Committee.
Thank you, Annie. For those of you who are guests of AgForce tonight, allow me to briefly introduce our organisation. AgForce is a peak organisation representing Queensland's cane, cattle, grain and sheep and wool and goat producers. AgForce provides advocacy to advance sustainable agribusinesses, and we strive to ensure the long-term growth, viability, competitiveness and profitability of our sector. Over 6,500 farmers, individuals and businesses provide support to AgForce through membership. We thank all those members present tonight for their ongoing support for our mission. Sustainability is among the key policy areas for advocacy at AgForce. We have a Sustainability Committee, which I chair, and Annie is the Secretariat. Our committee members own and manage cattle, sheep, cane and grain properties, and we are also fortunate to have members from our corporate partners. Together we meet to discuss and coordinate efforts around sustainability policy for agriculture. We have identified that there's a key need for continued education and informed dialogue, which is why we have convened this series. I'll now pass back to Annie so we can hear from our speakers. Thank you.
Thanks, Mark. So tonight we're hugely pleased to hear from our guest speakers, Ben Waters and Claire Watson at FTI Consulting and Nick Hammond from Suncorp. So we'll kick off with Ben and Claire from FTI Consulting. Ben and Claire, I'll hand over to you. If you could start with introducing yourselves and your work area at FTI, that would be excellent.
Thanks, Annie. Yeah, thanks, Annie. Yeah. So first, I'll go first. We'll do a brief introduction of Claire and I, then we'll walk you through the presentation we will deliver. We've got a lot of stuff in there. And we'll only touch on, I guess, a select few slides, but we're very happy for the AgForce team to make the slides available to anyone who would like them post the presentation. There's probably a bit more information in there than we would be able to get through in our 20 minutes. But firstly, my name's Ben Waters. I've been with FTI now for a bit over 10 years and look after our ag and agribusiness practice. I have my colleague Claire Watson here with me as well. I'll ask Claire to introduce herself in a second, but Claire and I look after ag across a very broad spectrum. So ag for us is everything from supply chains all the way through to primary production. And also we look after Australia, Asia Pacific and the Middle East. So it's a pretty broad mandate. I've always been in agriculture in one form or another. I grew up in northern New South Wales, where I was lucky enough to be able to buy the farm off mum and dad about 17 years ago. So I have an active role in ag. And then the most of the work that I do is working with family businesses around how they go through their processes of growing, managing risk, looking at how they might bring kids through the business, all those sorts of things. So a really sort of hands-on approach to how we help our clients. The other part of our business is helping people invest in agriculture. Not so relevant for tonight, other than what we're talking about is a really important part of what people are looking at now before they make any investment into ag or the supply chain. So I'll hand over to Claire. We'll then go through the outline of the presentation and then go forward from there.
Thanks, Ben. So as Ben said, I'm Claire Watson. I've been with FTI for about 3 years. Like Ben, I have, I guess, a I grew up on a farm in New South Wales, so agriculture's been part of my life for its entirety. It's led me to be working within the industry, and that's sort of a key part of the work that we do, is overlaying a core industry knowledge across financial and strategic advice when we're working with our clients. The work that I do spans sort of the full range of the project work that we do, but my focus is probably more on strategic and advisory work. So the work that we're discussing tonight, we're going through a few case studies. Some of that is around sort of the ESG and sustainability work that we've done in the past, and something that we sort of continue to advise clients on as this industry and the new emerging trends are growing.
Thanks, Claire. I guess in terms of the presentation now, look, we've done a little bit of the overview, so who FTI is. I should also say we're very proud sponsors of AgForce and have been for about 7 or 8 years now. We're going to touch a little bit on what we're seeing as some of the drivers behind the focus on ESG from both, I guess, the push and the pull. So the push being finance and the pull being the consumer. One of the things that we see as a real challenge for people around ESG and how they are managing their impact on the natural environment is just how do you start that journey. So we'll go through a few case studies around how we've seen people start and what are the important things, and then just some observations that we would like to make, I guess, in terms of the the overall market, and what we see as we're sort of, I guess, carrying out our projects, helping our clients, and therefore we're very happy to take some questions at the end as well. They always make these things a little bit more useful. So if we could go through to the next one and keep going through to So might go to the next slide. So I guess one of the things that we're really seeing at the moment is a real focus by both ends of the sort of the key inputs. So one being capital, and two, the consumer into our I guess supply chain from an ag perspective. They're very, very focused on what's happening on a number of different things, but in particular around ESG. And so what we're seeing is, if I look at from an investment point of view, sort of 4 or 5 years ago, people would have said, investors into ag, whether they be banks or private equity or pension funds or whoever it might be, family office. 5 years ago, where ESG sat on the importance was, it was probably ranked at 4 or 5. It was, I need to see an asset that performs like this. I need my investment to return something like this. I need my money back in this many years. And then, after that, I also need to make sure that what I'm doing does no harm. What we're seeing now at the moment is doing no harm is the first box we need to check. And so if we're as an industry, this is becoming a hugely important focus for those that are participating on the outside, looking in from the outside. And so the things that we are really seeing is making sure, people wanting to make sure that the funds that they might be putting to work are being used in an appropriate way, and they really are trying to make sure that their reputation is maintained and looked after. So that alignment of funding coming in and that being with sustainable outputs. There is a real focus now on being able to quantify what is my footprint in what I do, but not only my footprint on farm, but what is my footprint post farm? How does that work? Who is interested in that information, and how do I guess maintain that? There's a lot of people wanting to make sure that they aren't, from a finance point of view, they aren't accused of greenwashing or virtue washing. So again, they're looking to the industry to make sure that they're able to quantify any claims that they're making. And we've often seen people be able to report quite detailed and diligently around financial assets. The finance market is now expecting us to be able to report on a similar basis on our natural capital as well. And, as the slide says there, the last thing, net zero is becoming the focus, and almost the norm. And, people are really having to be very careful about the claims they make around that, and also the pathway that they're taking to get to that point. So that's sort of what we're seeing from a financier's point of view. It's becoming, the most important piece before we get to financial returns and longevity of investment and all those sorts of things. So it's certainly a key point. And as an industry, we need to be very focused on how we facilitate that capital coming in. And some of the case studies we'll talk about tonight are both, one that I'll talk about and one that Claire will talk about, are both around how we've had to get through this gate before we've been able to go any further. If you could go to the next slide. The other, so we've got a real push, in terms of the finance aspect of people looking in and saying, I want to make sure that my money is being put to work in enterprises and opportunities that are doing the right thing. The other really big driving force we're seeing is the pull through from the consumer. And the consumer at the moment is probably more interested now than it has been for a long time around where food comes from, the supply chain that it's travelled along, how the food or the input has been treated along the way, especially from an animal welfare point of view, and then how does it end up on their plate. And so we're really seeing consumer demand starting to focus in on these key points. The consumer is asking questions of the supply chain. So the consumer says, I demand to know these things. It's very important that I understand where this piece of meat came from, or where this fibre was grown, or where this grain came from. That then the supply chain then has to turn around and say, well, I'm going to try and answer that question. And eventually it comes back to being a producer obligation to meet. So we're really seeing, that pull through from the consumer, which is forcing the supply chain to act. And then the other part is that we're seeing, the finance area pushing it through. And a really great example of this is we had we were advised earlier today that one of the larger meat processors here in Australia had been put on notice that if they weren't able to reliably report their Scope 3 emissions, that one of the large supermarkets would no longer be able to buy their meat. And so we can see that now that this is really starting to come to be brought to bear on the supply chain, and it's really important from an operator point of view that we're right across this and able to start to respond to these requests. And I'll hand over to Claire now. Oh, sorry, no, there's one more slide for me to go through. And what is the role that ESG is playing in business? So the environmental piece, that's where we started the conversation. That's a very large focus. But when we talk about ESG, and I know we're talking mostly about natural capital tonight, we really want people not to forget about the S and the G. And if you think about where this journey started from Ag, it really was in the social space. ESG probably became a real highlight or a key area of focus for Ag off the back of some of the animal welfare issues that the supply chains were I guess, asked to explain, sort of in around that live trade ban. We still see that animal welfare being as a significant issue. We then rolled into wages and wage theft. And so, whilst environmental is really important and the focus for tonight, we also encourage people to think carefully about social and governance as well. Because at the end of the day, if there is an issue, whether it be environmental or social, it is the leaders of each business that are quickly brought to task on how this is going to be resolved. So we'll go back to more of the environmental piece, but absolutely, you need to have a very broad look at ESG when you're looking at it from in relation to your enterprise and the supply chain that you operate within.
Thanks, Ben. So we won't go into sort of too much detail and risk stepping on Nicholas's toes regarding his presentation, but I guess we wanted to provide a little bit of context around what we see when we speak to our banking clients. And a lot of this is driven by what their major regulator, APRA, is sort of putting out. So this is from their older regulation, which they're in the process of updating. But really, APRA is focused on helping banks to manage their overall sort of financial risks that might be related to climate change. And so while it's sort of financial risks as a bucket, what we see when related to climate change is sort of around the physical risk, sort of the potential of direct damage to assets or property, transition risk, so disruption to a business from adjustment to a low emissions economy, and then a liability risk and sort of what might happen if they're not considering or responding to the impacts of climate change. So it's sort of the way that we see it manifest is around how banks are helping their clients as sort of the flow through to navigate what this might look like for them. And so the key role that we might play, and the case study that Ben's going to speak to, is around how we help clients to understand sort of what these major buckets might look like for the bank and how that can be translated into how they're operating, and then understand what that might mean going forward.
Thanks, Claire. So we've gone through a bit of the background, and you might be sitting there going, well, that's great, Ben and Claire. So what? Like, what does that actually mean for my business? And the first case study I wanted to talk to quickly was a family business that we were helping in Southeast Queensland, mostly driven by cotton, but a very large broadacre exposure as well, and a very healthy cattle business. And so this was a project that we've been working with this family now for 5 or 6 years. They engaged us to help them look at some potential acquisitions. They were in a position where they were able to look at this particular acquisition on a debt-only basis, so they didn't need to bring any significant outside capital other than what they had available to them and what their bank was prepared to lend them. And so we went through the process of assessing the opportunity and looking at how this particular property would plug into the broader portfolio, and everything was fine. But what sort of, I guess, caught our clients by surprise, and this was an Australian bank, one of the larger banks in the ag space, as part of the due diligence, dropped in a questionnaire on ESG. And so our clients became very concerned because there was all of a sudden, having been with the bank for 20 years, they were now being asked to talk through what are the things that they're doing to manage their environmental footprint, but also their social and governance aspects as well. And so, and I'll come back to this a little bit later in the presentation, but the key here was helping them understand the key things that they were already managing, they were already doing, because as we know, farmers have been very good for a very long time at understanding that without the natural environment working with you, the business will have lots of different issues. And so we've always been good at managing the natural environment. It's developed over time, but what we haven't been good at is actually stopping and documenting what each of those steps might be. And so I'll come back to a few more examples, but for this one in particular, so our clients were asked about potential runoff. On their irrigation farm, not a single litre of water is wasted, and so they could clearly show that they were managing runoff, and they were making sure that water wasn't ending up back in rivers where it shouldn't have been. There were some particular wetland areas, and again, they had been deliberately set aside to allow for biodiversity, not because of a policy, but because of it being a good thing to do in terms of managing the land. They were engaging with First Nations community, employing a couple of workers each year out of the local Indigenous community. There was all these things, but they never stopped to think about it in the context of the environmental management and social governance, but the environmental management they were taking in relation to their enterprise. And so, we were able to, just by stopping and going through what they did on a day-to-day basis, they also were quite surprised at how much of their natural capital they were managing just as a matter of course. And so, we were able to get this loan through, and it was it's a substantial loan, north of $80 million. But part of it was them being able to explain to the bank that they are taking steps to start to manage this. And we're now seeing this as almost a regular part of either a renewal or any new finance application from a banking perspective, that these are important. They're important pieces of information. So if you're thinking about it from an operating point of view, why would I be interested in this stuff? Very soon, if not already, your bank's going to start to ask you questions about this. So the policies, the procedures, and the stopping and thinking about what you're doing is going to be crucial. But I'll come back to a few more examples of that in a little bit further through the presentation.
So as Ben touched on earlier in the presentation, when we look at capital provision, there are sort of broadly two buckets that we would look at. So there's the debt coming from banks and then equity coming from investors, which, it can sometimes be private credit. But if we look at it broadly as sort of bank and non-bank capital provision, what we see is that investors are increasingly focused on ESG and sustainability focused investments as a form of risk management. This is not all investment mandates, but we are increasingly seeing and I've broken it into 7 common strategies. There are obviously lots of different types of ones that won't fit into these buckets, but really common ones are sort of positive screening. So looking at investments specifically because of their attributes that add to sort of ESG or sustainability. A negative screening might be that they won't invest in certain industries because of perceived attributes that don't fit within their mandate. So that might be mining or something that sort of is not seen by them to fit within their ESG sustainability focus. Portfolio tilt might be something where they have, a slight more focus on ESG and sustainability. And then sort of we're working through the other 4 that we've got listed here, and they're sort of, I guess, more specialized focus, but ESG integration is where they might be looking to incorporate more ESG and sustainability investments into an existing mandate. Shareholder action is sort of things that are being driven by the people that are providing capital at the back end. So it's responding to how their stakeholders are expecting to see their investments be returning. Activist investing, again, it's sort of providing capital to create that positive impact, where that is putting their capital in something that they believe is going to create sort of the positive flow-on effect. And then sustainability themed investing might be something where they'll have a specific bucket. So it might be social welfare, or it might be food and environmental focus. And the one that we're going to speak about as a case study sort of fits across a few of these different themes, but it was a global investment firm that we have done some work for in the past across different investment portfolios, but this specific one was for their sole ESG food sustainability investment mandate, and it is a global mandate. They invest heavily across Europe and the UK and have a few investments in Australia. They were looking to invest in a leafy greens business in Australia, and the key sort of engagement that we had was buy-side due diligence. So we were looking at the business holistically. We were looking at the financial, the commercial, the operational, but most importantly, the ESG attributes of this business. So in a 100-page report, I think 40 of the pages were on ESG, and this was a key focus of theirs in terms of understanding whether that was a viable investment. So the financial and the commercial attributes, while important, were far less of the sort of, I guess, deal breaker in terms of what ESG was for them. And the focus for the review was to see whether this investment would fit within their broader portfolio. So they had fairly strict metrics that we needed to review. We had to look intensely at their workplace health and safety management. We had to align how they were operating across a whole range of different metrics to the SASB Sustainability Accounting Standards Board requirements, which has sort of now been superseded. But at the time, it was sort of a key focus of theirs in terms of understanding how the business they were looking to invest in fit within its industry's best practice, and then where it could potentially go to. So part of the investment review was to look at how the operations were at the moment, and then to help them to develop a 100-day investment plan. So what that was is post-closing of the deal, what were the key actions that this business could take to show that it was able to continue on its sustainability journey? What were the key identifying sort of areas of the business that could be improved? So that was around chemical usage, input management, wastewater management. There were sort of key areas where the investor was very focused because they were subject to EU and UK sort of more strict regulations. And that's something that we see increasingly, especially from the investor point of view, is that where they are aligned to a global mandate, it's not just about what's happening in Australia, it's also about thinking globally about these things. And that, I think, is something as well that we see with banks, with consumers, how that is driving what the reaction is in Australia is far more global than just what is happening on farm or in your state or in Australia.
And just, I guess, just to wrap up quickly, one of the key things that we see here is people feel quite daunted about where to start. And so if you could just click through a few slides there to the reframing one, Claire. Yep. The most important part here is firstly just taking taking those first couple of steps. And look, you know, there's a lot more to it than this, but what we encourage people to do in that first sort of look at this is to think about the things that they're doing on farm. So, you know, what trees have been planted, you know, where have they been planted, what vegetation has been managed separately, you know, how are you looking at tillage, you know, moisture management, you know, crop rotations, you know, crops that are planted and essentially promote, you know, healthy insects and things like that, looking at solar. So there's a whole range of things that people are generally already doing. But the first step on any environmental management plan is to look at what you're already doing and then to start to document then. And then, you know, the next slide we won't go through, but again, it's, you know, we'll make it available to, you know, the group is around, you know, the actual how you put a plan together. And I think we've covered a fair bit of ground there. And Claire, I might get you just to wrap up with some of the benefits that we're seeing so that we don't eat into too much of next time.
Thanks, Ben. So you know, the benefits are multifaceted. We see them across lots of different areas of how your business might operate. But I guess if we wanted to break them down or summarize them, a key one that we see is market access. That's something that Ben's touched on already. I think that whether it's actually happening now or it's something that we're being told is coming very soon, it's about engaging with the idea that you're going to be part of the broader climate change supply chain. It's not just about what you do and selling your product, you're part of someone else's impact. And so being able to report on and explain what you do will provide you with that guaranteed, or like at least it will help to underpin your market access going forward. Similarly, we see that being able to report on and explain how you engage with the ESG aspects of sustainability will help to provide you with better access to capital. It's something that we hear investors talking about all the time. It's something that we hear banks talking about all the time. And it's something that customers are looking at as well. So if you can't sell your product, then it makes it harder to get financing. Another thing is around improved business valuation. So the areas that you're investing in terms of sustainability or social outcomes, that's something that will help you to underpin your business valuation going forward. Now, while we don't necessarily need to focus on the things that will improve the valuation, it's a lot of this is also around stopping detrimental aspects of your business. So product premiums, we might not see that there will necessarily be discounts for not having certain criteria met, but what we are seeing is that demand for the products that do prove that they are adding value through its sustainability outcomes, and there's the potential for the premium on top of what you're getting as a base level. And the other things that we see are the more tangible, intangible sort of stakeholder goodwill and benefits is sort of around what is consumer perception of not only your business, but your industry as a whole, and how sort of improving the sustainability outcomes and being able to explain what your sustainability outcomes are will help to improve client loyalty. It will help with the customer perception overall of the industry. And it also has the potential to avoid things like penalties or the negative aspects that could arise from not being able to sufficiently explain what you're doing in your business to address key risks around climate, around social, around governance.
So we'll wrap it up there. Thank you very much for your attention. Look forward to some questions. And I guess the last point is, the most important point out of this is on this journey in relation to this is taking that first step. So thank you. Sorry, Nick, we've probably run a little bit over time there, but over to you.
Yeah, nice one. Thanks, Ben, Claire from the FTI team, and thanks AgForce for having Suncorp Bank along to talk a little bit about sustainability and why it matters for banking industry and why it also matters for our customers as well. So I've been at the bank for 7 years. I've been in the sustainability space for about 3 years, overseeing Agribusiness is one of our large exposures, also home lending and our deposits portfolios as well across the bank. So a bit on the agenda tonight before we get in, starting with an overview of Suncorp Bank and our own agribusiness exposure, moving to the different lenses a supply chain may take on sustainability, inspired by the first AgForce webinar. Next, some regulator expectations of banks in managing climate risk, including some examples, followed by Suncorp Bank's current priorities in supporting its agribusiness customers in sustainable opportunities and challenges. And lastly, an overview of Suncorp Bank's 10 customer pilot of AgCare assessment reports for predominantly beef producers in Queensland. Opening with why agribusiness matters to Suncorp Bank. Suncorp Bank's roots are proudly traced back to agriculture, starting as Queensland Agricultural Bank in 1902. The chart on the left shows, as at 2023 end, we are predominantly a home loan lender by exposure, but our next largest exposure is to agribusiness, 6.5% of our total lending, 3/4 of which is beef or grain and mixed farming, with significant exposure to Queensland. Suncorp Bank supports its agri customers through a dedicated relationship manager model and is dedicated to support its customers as challenges and opportunities arising from the transition to a net zero economy. Next slide is some context linked to the first AgForce winter webinar held 13th of June. The webinar was presented by Professor Richard Eckhart from Melbourne Uni and Claire Mahoney from Australian Agricultural Company, AACO. Claire presented what I thought was a thought-provoking slide, this one here, on different ways of looking at the situation between stakeholders. The recording of the session is on AgForce's YouTube channel for those who missed it. This illustrates the different views an academic professional versus a producer may have on carbon credits and carbon insets. Add in banks, food retailers, input providers, processors, valuers, and others, and there is a risk of the broader supply chain not moving together on sustainability more broadly. Forums like these and other industry initiatives or working groups are a good way to bring industry together and also be cognizant of challenges which may be either mutual or exclusive across the broader supply chain. So as a member of the ag supply chain, why is your bank asking or preparing to ask climate-related questions? A continuation on the last slide on perspectives, I'm sharing some top-down expectations on banks from regulators and government alike. Many banks have set voluntary emissions reduction targets, aka Scope 3 targets, within industries they lend to. These are made under voluntary commitments, such as the United Nations Net Zero Banking Alliance. This was highlighted in the first AgForce webinar as a main driver of activity in the bank space. Whilst definitely a factor, voluntary climate ambition and commitments is only one part of the puzzle. Local and global financial regulators and governments are increasing expectations on management of climate-related financial risks. The impact of this will be mandatory requirements for banks to not only measure and set targets and disclose, but effectively manage the underlying climate risk. FTI touched on this earlier a little bit briefly, but I'll flesh this out a little bit further from a bank's perspective. Starting firstly with APRA, the Australian Prudential Regulation Authority, a regulator. APRA is an independent statutory authority that supervises banking, insurance, and superannuation institutions, and is accountable to the Australian Parliament. APRA seeks to identify risks and take action before they actually occur. In November 2021, APRA released Prudential Guidance, CPG 229. Note it's guidance, it's not binding standard or legislation, it's sort of best practice, although the expectation is that it will move to legislation soon. The guidance has been supplemented by surveys and assessments from APRA to understand maturity of the institutions it regulates. Noting this extended to the bank's total lending activities, not just agriculture. Initial surveys and assessments were first completed in 2022. APRA is likely now analysing responses from a survey recently conducted as a benchmark comparison to 2022. Interestingly, in its recent survey, just a few months ago actually, it notably asked questions for the first time on nature risk, so the condition of biodiversity and ecosystems. So what? APRA has enforcement powers starting at supervision of board execs and moving through to capital adjustments, imposing licence conditions and civil and criminal penalties. From APRA's perspective, capital is a buffer available to banks to absorb unexpected losses it experiences in running its business. For example, losses arising from a customer being unable to pay their loans that default or are written off. APRA already mandates minimum capital levels for banks, which have been a significant point of focus post the GFC. APRA has already issued mandates for capital overlays to some banks for process issues relating to, for example, deficiencies in anti-money laundering or counter-terrorism finance processes. This has been in the order of the hundreds of millions of dollars for banks in extra capital to be held. Ultimately, in the medium term, a reasonable expectation is a bank ignoring or failing to adequately manage climate risk to APRA's expectation may lead to an APRA-imposed additional capital buffer, which equals higher funding costs for the bank, which may equal higher interest rates to end lending customers. It's worthwhile also taking a quick look at what's happening overseas. To a degree in Australia, we're playing catch up with the UK and the EU. In 2019, they commenced similar activities to what APRA has undertaken just recently. And in the same vein, in the UK and Europe, many of these guidance frameworks have since moved to supervisory and enforcement activities and legislative instruments. The European Central Bank has already applied additional capital requirements to banks that fail to manage climate and environmental risks. The so what for producers out of this? It is reasonable to expect that your relationship manager from your bank will start asking additional climate-related questions if they haven't already. A bank's aggregated portfolio climate risks that it's obliged to manage per APRA is informed by each of the customers that it actually lends to. Moving on from the regulators to the Australian Government Treasury, you may have heard about upcoming mandatory climate disclosures. The Treasury Laws Amendment Bill is currently before the Senate. It is proposed to be implemented as a phased approach, starting from FY26 with the large entities like banks, large retailers, and corporate institutional supply chain companies. All Australian companies meeting 2 or more 50 million plus revenue, 10 million plus assets, or 100 plus employees that will be in scope by FY28. Again, companies involved in agriculture are going to be seeking data from the producer to help them meet these requirements. Many banks and other companies have been making voluntary external disclosures under what's formerly known as a Task Force for Climate-Related Financial Disclosures, TCFD, but the point to make here is that we're moving from a voluntary disclosure framework to regulatory mandated or from the government. So now you're all experts on climate risk. Let's break it down a bit further. What is it and why does a bank actually care about it? Climate risk has the potential to materialise as a financial risk to the bank. Noted at the bottom of the slide, both through reductions in values of the bank collateral held as security and impacts to the customer and being able to repay their loans. Backtracking to the two key parts of climate risk in CPG 229 that are applicable in this context, transition and physical risks, which were also briefly touched on by FTI. Physical risk is a little easier to understand the drivers, but I'll spend some time talking through the transition risks, which are associated with the transition to the net zero economy. First example is the cost or availability of fuels. So the average national diesel price in the last 20 or so years has increased 77%. In the last 5, it's increased 36%. If this recent rate of increase persists, this is a significant cost and risk for producers. Next, international and or domestic government policies. Some examples. As most of you on the call will be well aware, 70% plus of total Australian agricultural production is exported. Therefore, being conscious of not only the Australian domestic policy, but international policy is also paramount. One example is the Europe border tax adjustment mechanism, which is now underway and taxes imported goods from industries including cement, aluminium, fertiliser, iron and steel, which come from countries outside the Europe without a carbon price. Could this be extended to further industries in the future? Possibly. We've also seen some radical overseas nations announce proposed taxes on agricultural methane. Denmark proposed theirs to commence 2030 and New Zealand obviously explored that one, but has since pulled that one with the change of government. Lastly, changes to consumer and market preferences and supply chain commitments. These speak for themselves, but market may increasingly price for carbon eco-friendly products. Most of you on the call will be aware of Coles carbon neutral beef. Some mitigants as a producer: consider completing or updating your farm business resilience plans. Queensland Department of Ag and Fisheries and QFF both have templates and how-to guides on this. And farm business resilient plans are also a prerequisite for accessing drought assistance grant programs too. Some examples within the plans include fire, so maintaining fire breaks, firefighting equipment in good condition; drought, including storing fodder, adequate water supply, long-term stocking rates and water efficient irrigation techniques. And another mitigant is also being able to baseline your emissions and natural capital, which I'll talk a little bit about that later. So just to reinforce why banks care is asset values, the customer's capacity to repay. A strong and resilient customer is going to be beneficial to the bank. Talking a little bit about what Suncorp Bank's current priorities and where we're targeting at the moment. Preface this with we're no expert on climate and nature, and this is a learning journey that we undertake with the broader industry. Some examples of what we are prioritising are, firstly, education for our relationship managers, the lenders, the front line, the trusted advisor to our customers. So all of our RMs have received full day of ESG sustainability training, but there's some more work to do on technical job-related training there. Whether it be equipping them to be able to talk about grants and rebates or assisting with the carbon farming registration process. Those are just some examples, and we recognise that it's no one-size-fits-all approach here. We bank a diverse set of customers, diverse set of commodities too. Secondly, supporting customers with baseline measurement, which I'll get onto an example that the bank's undertaken recently on the next slide. We'll get there in a second. Thirdly, supporting customers with carbon farming projects. So banks, as most would be aware, are an eligible interest holder, and that's a terminology used by the Australian government, the Clean Energy Regulator. Eligible interest holder is the security of the mortgage over the land in most cases. So we have observed that some carbon projects can have the ability to impact on the value of the land when we've got independent valuations back. For example, a HIR, human regeneration project, where rehabilitating the forest impacts on I guess, stocking capacity and how many cattle you can run or livestock, which in turn may have the implication of impacting on land values there as well. But in any case, the bank is, of course, supportive of carbon farming projects, but it just wants to make sure that it's not going to impact the core enterprise. Lastly, and this is the one that's always a challenge, there's so much going on. Got to try and keep across what's happening, all different commodities, and also state, territory, federal government, overseas updates. Some of the topical ones that are happening at the moment are Cattle Australia's land management commitment that some of you would be familiar with, that's currently under or just finished consultation actually. So they're trying to redefine or define deforestation in an Australian context. And I guess why that's pertinent at the moment is Europe's introduction last year of deforestation-free products. That was in June last year, and I think it's to become effective quite soon. And this is an example of a transition risk on the price line being able to access markets. Cool. On to the last one. So some initial outcomes of our AgCare assessment pilot. So we work with 10 of our Suncorp Bank lending customers, which recently completed AgCare assessments. These are all Queensland producers, predominantly beef with some sheep, goats and grain mixed in. Participating customers, you can see there on the map, they stretch from Bundaberg and Gladstone, moving west to Western Downs, Central Highlands and further. The pilot was a joint learning activity for our customers, ourselves in the bank, and also AgCare. The AgCare assessment measures across 4 modules within the assessment report: carbon balance, ecological value, sustainable management, and commodity. The table on the slide shows the different types of beef customers involved, the max being 7,000 head of cattle and the median a little under 2,000. The range of grazing area and number of head per grazing area, hectare, varied significantly too. A bit about the carbon balance module: net TCO2e, tons of carbon dioxide equivalent, which that's how carbon is generally measured. Outcomes varied significantly. You can see there on the screen, but that's kind of driven by the number of head and the different diversity of the customer set that went through this process. Ecological modules identified Queensland Government essential habitat and threatened ecological species, and whether they're in a Great Barrier Reef catchment, which I think was interesting for producers to be aware of. Koalas and yakka skinks showing up there. And the sustainable management and commodity beef modules assessed a number of different factors and scored these on a rating of 1 to 5 as well. So in closing, the point of this session from Suncorp today is an insight into what kind of information banks may ask, if not already, and the reason why banks are taking action. The AgCare assessments assist producers in measuring performance across a number of areas, also identifying opportunities to improve or consider. A key learning of Suncorp Bank from the AgCare assessments is that the information is quantifiable and can help producers tell their own sustainability story and be aware of what sustainability actually means, which kind of fits in with what Ben was saying, that a lot of producers are doing a lot, but it's being able to actually bring that all together and tell the story. So they all appreciated that, and it was great insight for us as well within the bank. So I might pass back to you, Annie. Thanks.
Well, thank you. Thank you, Nick, Ben and Claire. That was very valuable. There's so much food for thought there. It struck me that we've talked about ESG sustainability for so long, but now it's here and it's real and it's got a genuine impact. But also it's sort of somewhat encouraging to know that it's a journey we're on together. And AgForce looks forward to continuing to work with both of you to meet the new challenges and also realise the opportunities. So I'm personally going to look forward to rewatching this video and discussing it with my committee members and policy team. So that brings us to question time. Mark, did you want to kick us off with some questions?
Thanks, Annie. This is to both presenters. What are some of the actions related to sustainability that a producer may consider right now? And I know Nick's touched on a few, but it's such a busy space. Is it per commodity, or are there some general points that we can lock onto?
Yeah, I can start, and even just reiterating some of the points that I have made. So starting with, or considering a farm business resilience plan. So as I said, QFF and DAF have those free templates and how-to guides. Consider baselining of emissions. So AgCare, obviously an option, and Australian Innovation Agriculture's environmental accounting platform. That was one that was funded by many of the RDCs, Research and Development Corps, for the commodities, and it's free, it's readily available. There's some limits to it, but you can jump on and do that one. And I also encourage you to jump on and have a look at your RDC's website for getting to your point, Mark. There's differences amongst the commodities, but MLA, Hort Innovation, they've all got some great info on there. Jump on, take a look.
Yeah, thanks, Nick. I reckon that, that's a really sensible place to start. The other thing that we encourage people to do is just to think about what they do on their farm on a day-to-day basis, and how that, their interactions might be to protect a certain area or look after a particular part of the farm because it has a bird or something like. So there's a lot that people are doing that they just actually haven't stopped and thought about it in the context of ESG, and in particular around environment. As I said earlier, farmers have known for a long time that you have to work with the natural environment, and the natural environment, when you do work with it, it's going to look after you much better than trying to fight it. And so we really encourage people to sit down as a family and start thinking about the things that they do, like how do they manage water? Have they fenced a riparian area off? Have they looked at different types of tillage? Are they spraying? Are they spot spraying versus blanket spraying? All these sorts of things. There's actually there's usually a lot that people are already doing that they actually haven't just stopped to think of it in the context of this, and that's a really good place to start, because then as you go to the tools that Nick mentioned, you then end up saying, okay, well, here I can put this bit in here, I can put this bit in here, and it's persistence of this that is the most important thing. Like it's a real journey, and with all journeys, as they say, that first step is the most important one. You've just got to start.
Oh, thank you. Great answers. Noel's got his hand up for a question.
Yeah, thanks, Annie. I'll hand over to John.
Yeah, Nick, John Moore here. I was just wondering, it sounds like that the people who are doing the right thing are going to be rewarded. Obviously, from what I can see is that people doing the right thing, and what Ben was just talking about, there might be that they get financed at a cheaper rate than people doing the wrong thing, or that probably what will happen is that people who are doing the wrong thing won't be able to be financed. Do you reckon that's what's going to happen in the not too far future?
Yeah, it's a good question, one that we have a think about and put our hat on and go, what's going to happen in 5-10 years? I think for now it's too early to tell. We're trying to still understand and get a good view of what good looks like for all our different commodities and who we actually bank there as well, which is part of why we're on this journey of baselining, helping customers come together, learn a little bit more about their own business. We've observed some banks are offering green loans, and that's on the basis of activities that the customer's taking out. But I don't believe that's necessarily on the whole farm debt level. It's for the purpose of one single loan. So take into consideration, the ESG sustainability credentials within pricing and risk as a bank that's an emerging area, and that's something that over time, we're going to show greater interest in looking at. We're probably still a little bit too early in our journey, I would say.
Yeah, Nick, I sort of see it as sustainable. Is the whole landscape and is everything sustainable, and even comes down to the workforce and the whole, you know what I mean? Our soil is so important, and if what we're doing is we can improve our landscapes and be sustainable, it's a win-win for everyone.
Yeah,
definitely.
I think it's something that we see from our client point of view as well, is that it's it's not just about whether it's getting a cheaper interest rate or not being able to get financing. It's also about banks wanting to partner with their clients for the long-term future. So making these interventions, helping to make your business more resilient. We know that there's been highly variable climate over the last, like recent past. Yes, you can say it's always been variable, but we're seeing lots of extreme events, and banks ultimately want to help their clients to be around for the next generations after that. And we now just have more tools to be able to address that. And part of that is looking at these sort of resilience plans, looking at sustainability, but it's the bank's prerogative is to make sure that you're able to survive through the next generation. And part of that is looking at these different ways of managing and being able to understand what more you can do, which is, you know, it's not maybe a discount on financing, but it is still part of making sure that you're around for that next generation.
And I think, John, just to add to what Claire said there, I think I don't think it'll be so drastic as that you can't get finance. I think it'll just be more expensive. And so, because if you think about, there's already some indications around what's going to happen. If you look at the poultry industry, for example, and you look at RSPCA accredited chicken versus non, there's still quite a lot of non RSPCA accredited chicken produced. It's just it goes to a different market, and it is subject to different pricing. So my personal view is that what will happen is there will be very clear price indicators that will support those people that are doing the right thing. But I don't think it will be for a fair while. I don't think it'll be a black and white rule of you're not doing this, you can't get finance.
Yep. No, that's explained really well. Thank you.
I've got a question. Thanks, Ben, for that. Yes, and your question, John. I've got a bit of a question, I guess, or just a discussion point, I guess. And I might owe John a beer after this, but John, what are your thoughts on property markets and how this will impact different property sales and land types?
It's really difficult because I sort of see all of this is like people doing the wrong thing. It comes down to not looking after their land and soil. So if I'll be put on the spot a bit here, but looking at it from a value, if I go for a drive around and a property's run down, like it may have been, maybe is overstocked or overgrazed, I always look at it, what is the potential purchaser who would go and look at that and go and buy it, think. So if they go along and look at, go and buy a property and then the markets buy a property and say, well, look, the person who's been running this for the last 20, 30 years, because in a lot of the cases, that's how long an owner's had a place, they'd say, well, what they've been doing is sustainable. And I think the sustainability thing is the most important here, is they'd say, well, look, whatever they've been doing, they've been looking after the land types. That builds carbon, that builds, that whole sustainability thing, and it's obviously got good ground cover. So going forward, we know that we're going to have to put a lot less inputs to get that property up to producing what it should be than a property that's probably been run down. So if you're looking at a property that's run down, it might be that you have to, only run half the amount of cattle there, or you might have to put significant capital into, say, blade ploughing or repasturing it to get it up to where it should be because it hasn't been looked after. So, I look at it as sustainability. Is it just the soil? And then also, too, the sustainability comes into, it might even come into capital, is to make it easier or to run that place. So, I always try and view everything is what the potential purchaser would look at is when they buy that property. So, and that's what I see is that if someone goes in, they look at a place, they say, well, look, this has been really well looked after. It might even have some offsets that are producing some income, which, which may well help it. and that's how I like. It's building it as a business and also too as an asset. So if you're looking after that asset, and it's in good, it's in good shape, it's going to be a lot more attractive in the market than a property that hasn't been looked after.
So the links are very strong between our production systems and sustainability and ESG outcomes. There's a very close link as to our management style and management decisions and how it impacts both at once. And I think that's a point that, or a learning from tonight anyway, from me, that it takes away a lot of the fear out of these conversations that some producers will inevitably have. Thanks, John.
Well, I think it's what's really important is that with ag, most of our farmers, our assets, our number one. It's our number one. It's our biggest thing. It's our biggest asset. We spend our lives putting all our resources into building up and developing this asset. So you want to look after it. And a lot of the things that are being talked about here tonight, and looking after your land and your soil, and like it's all about building up that asset, and that. So if you're not looking after that, and you're decreasing, obviously you're decreasing in value of your land and its earning capacity.
Absolutely. And Nick, I guess I'm putting you on the spot a bit here too, but the issue of having certain projects and certain carbon or whatever it is attached to your title, how does the bank view? Is that a plus or a minus, or it's just part of the gig and you just go with it?
Yeah, it's an interesting one. And banks, as I mentioned earlier, we're providing consent upfront for those projects to commence as an eligible interest holder. So
Yep.
we wouldn't be providing consent in the first place if we didn't think it was in the customer and the bank's interest there.
Yep.
There are a few questions that we still have around certain scenarios as they play out. For example, like fires coming through and removing all the carbon abatement there. We've actually got a session with the Clean Energy Regulator booked in for next week to ask some of these sort of case study questions. But I think it's going to only become more prominent, customers taking advantage and being rewarded for these schemes, whether it is the Australian carbon credit units or other overseas schemes. So it's going to become the norm, and the market will kind of just grow to accept those on the title. I think there's also some options with soil carbon, and speaking to one of the big project proponents to kind of discontinue projects in some instances. But again, it's on a case by case basis. So all has to be worked through.
Yeah, no, that's right, and definitely the political landscape can change, and if we don't need to repeat at a federal level of the climate wars, thank you.
Well, thanks everyone. I'm reluctant to bring this discussion to a close, but I'd be failing in my duty as facilitator if I didn't let you all get back to your evening and your personal lives. So thanks again to our wonderful presenters. That was just so brimful of information, and I'm very grateful you made the time in this personal time to speak with us. Okay, so please keep your eye on your inbox and your social media for information about our upcoming webinars. The next one will be on the 7th of August to hear about some work being done in precision livestock research at CQ University in the Institute for Future Farming Systems. So Thomas Williams and Diego Costa will be presenting to us about cattle production variables and methane emissions. So we look forward to seeing you again on the 7th of August. Thanks again to our wonderful presenters, and good night.
Thanks,
Thank you,
everybody.
everyone.
Thanks all.
Bye.